Joining me now to talk more about the markets is Rod von Lipsey. He's Managing Director at UBS Private Wealth Management. Rod, it's great to have you on the show today. And in the wake of this better than expected retail sales data, how does that impact what we might hear from the Fed tomorrow?
Well, I think that we are looking forward to, as you mentioned, a 25 basis point rate cut. I don't think that Chairman Jerome Powell is going to frustrate the market or disappoint everyone with anything less than that expected rate cut. But certainly, we're starting to see signs that maybe the consumer, maybe the economy, things are strong and they're good. So perhaps we won't get all of the interest rate cuts that we expected to receive next year. And so that's part of what we're seeing. We're also seeing the 10-year Treasury has been rising slowly, getting up towards 4.5%. And the market doesn't necessarily like that because it implies that maybe there's some more weakness ahead.
We have seen stocks take a pause near record highs, but still notable that the S&P 500 is up about 27% this year. So a banner year, to say the least. What does that mean as we enter 2025, and what are you advising your clients?
Well, it's certainly been a banner year. And there's a lot of concern out there because we're looking at S&P valuations at about 23 times earnings. That's really getting up there and it's feeling a little bit frothy. And so that might be a reason that we're seeing a pause. And then some institutional investors have had a fantastic year, as you pointed out. And so maybe taking a little bit of the chips off the table and going home for the holidays and considering it a win, that's a good thing. We're telling our clients, though, that we expect that 2025 will continue to be a very supportive market for equities, especially for risk equities, because we're seeing everything come together. We have a Fed that is planning to cut rates. We might argue, is it going to be 3 rate cuts or 4 next year? We're seeing a president who is taking a look at the capital markets. Him ringing the bell last week at the New York Stock Exchange wasn't lost on anyone. So we have a president who's going to be looking at his scorecard by how the economy is doing, how the markets are doing. We've got a very, very strong U.S. economy and a U.S. industrial base. So this is setting up by just about every measure to be a good year in 2025. So that's one of the things that we're telling our consumers.
I want to get your take, Rod, just in terms of how you're factoring in the tariff conversation. We've had guests on this show say that really some of the tough tariff talk is nothing other than a negotiation tactic at this point. But of course, if it does become reality, economists have estimated that it could weigh on the economy. So how is that factoring in to your outlook?
Well, we're just like everyone else. We're really thinking about that as being one of the risks. And that's one of the key risks for disappointment in 2025. If in fact there are tariffs and they are perhaps as onerous as some have suggested, there certainly will be a retaliation. And none of that is good for the markets. None of that is good for the U.S. consumer. And it certainly won't be good for the U.S. capital markets. So that's a risk that's out there on the horizon we're thinking about. But we won't know. And those tariffs are going to be perhaps a tool for getting policies and things that we want. So that's a negotiating condition. And we really don't want our investors to really look at that and feel that there's going to be something that happens on day one. We're going to need to watch the tea leaves here. But that's certainly a risk for 2025. Again, as are some of the valuations and the mismatch that we're seeing in valuations. Coming back to it, though, when we look at the underlying trends, we see strong and supportive growth. We see areas like AI and technology, especially the software pieces of AI, showing us real momentum and real opportunity for earnings growth. So tariffs, absolutely, big risk. But we don't think that investors should be focused specifically on tariffs. We think they should just let this play out, let the president take his negotiating stance, and we'll see what happens when 2025 rolls in.
For consumers watching the show right now, wondering, are grocery prices going to go down? Will I finally be able to save more in the new year? Do you anticipate that inflation can reach the Fed's 2% target?
Well, I think that the Fed is pretty darn committed to that. But we have a real challenge, and that is that many Americans, and this is reflected in this selection, many Americans are looking at the prices of everything from groceries to holiday wreaths to Christmas trees, and they're staggered by the fact that even if the inflation is slowing down, on an absolute basis, things are still expensive. and they're very expensive for a lot of Americans. Will we see those things go down? I think we're seeing the pace of increase slow, and we're starting to see some modest reduction in prices. We're starting to see some modest reductions in home prices and things like that. But wage growth is still strong. Wages remain robust. The employment levels remain very robust. So it's going to be a while before we start seeing those things come down. Those items that are geared to energy prices, there in fact may be some opportunity for those to be the early movers in price reductions. But as far as food, dairy, those types of consumer products, they are high, they're going to stay expensive, and we think it will take a while before they start to move themselves back down, or consumers start to get used to looking at prices that look familiar to them and don't feel like such a sticker shock.
Rod von Lipsey, Managing Director at UBS Private Wealth Management. Rod, thank you so much for joining.
Kristen, thank you. Happy holidays.
Happy holidays.